Tariffs, it's all the news, everyone's talking about it, and if you're Canadian, it's going to affect you more than you know. In today's video, Aaron and I are going to break down how this could possibly affect you as a real estate investor, as a homeowner, so stay tuned. Hey guys, Josh and Aaron back for another Finance Friday, and it has been an absolute crazy last few weeks. Aaron and I are excited today to chat with you about one of the things that are impacting or are about to impact Canadians on a massive scale. We want to talk about the elephant in the room, tariffs. And for most people, tariffs have never really been a thing that they've had to talk about, understand. So before we get into how tariffs are going to affect you, affect real estate, how you can be situated to move forward in Canada and to purchase real estate, let's talk about what a tariff is first so we're all on the same page here.
A tariff is just simply a tax on an imported good. So the tax is going to come on to the goods that are being imported into the States out of Canada. Obviously, this is going to increase the costs of goods coming into the States and the cost on the consumer's end. From the U.S.'s standpoint, what that will do inadvertently on the Canadian side is obviously produce potential loss of income or reduce income for the companies that are producing these services and these materials that are being imported into the States. And then obviously further down the road, or maybe more so immediately down the road, like we may start to see the job loss and the unemployment numbers get affected from the Canada side. Yeah,
and you're probably wondering, well, how does this affect real estate? How is this going to affect me? If our economy essentially grinds to a halt because our largest trading partner it's no longer advantageous for us to be able to provide them goods that we make, then we start to have challenges with, as Aaron said, high unemployment, serious stresses on small businesses, and overall stresses in the market for people who can't afford their already escalated payments. Where Canada really is right now economically, we're just kind of coming out of a not recession, but very much a recession. COVID essentially wiped everybody's savings, small businesses closed. Canada isn't in the same situation to deal with an economic disaster as we were at the start of COVID, which is alarming when it comes to how much debt people have and how we're going to navigate through this if 25% tariffs really do come into effect. So, first thing we want to really take a look at is unemployment. Now, Aaron and I had a chance the other day to listen to a TD economist talk, and that TD economist was at the Regional Home Builders Association, and he was talking about really game planning worst case scenarios. What is going to happen worst case from TD's eyes when it comes to unemployment, when it comes to asset prices, when it comes to home sales. Essentially what they boil it down to is unemployment, they would expect to reach around 8 to 9%. And I believe the numbers today came out at, I want to say high sixes. What that means is there's less demand for goods, and when there's less demand for goods, the overhead needs to be cut, and small businesses will then cut people to be able to increase their profits, which will then cause higher unemployment rates in the country. That is an economic lever that the Bank of Canada is watching when it comes to being able to change policy rate decisions. And this is really where it comes down to how is it going to affect you as a borrower or somebody who has debt, whether it's on residential real estate or commercial.
Yeah, obviously what we're looking for here is like, what is the trigger mechanism and what does that do for like the Canadian economy? And one of those things is it's going to start signaling to the Bank of Canada that, well, okay, we need to start cutting the rates a little bit. And earlier this week, so early February, there was just conversation from, I believe, BMO where they all of a sudden predicted about 6 bank cuts to come from that. So we're already seeing with just the initial talks on the tariffs. I think where we were supposed to have maybe 2 rate cuts this year, we've already jumped up to 6 rate cuts. So in the immediate future, we're going to see borrowing and debt become a lot cheaper on the interim. So that is going to be somewhat beneficial for borrowing, buying power. Now, obviously on the residential side, we do obviously see the correlation between lower rates and higher homing prices. It does create a more of a seller's market because the affordability is there. These sellers are able to get a little more bang for the buck on the sales price. So something that we just always talk about in general with real estate is not always just waiting for the mass adoption of everybody else getting into the market, right? As these rates start to drop and everybody starts to take a look at buying real estate, it's almost already too late, right? We know these home prices are going to start to go back up once people start getting into the market and purchasing, and probably going to see somewhat the same on the commercial side as well too. We've already seen Bank of Canada Prime, we're at 5.2% today. That's already creating lower and cheaper bridge debt. We're seeing that across the board for the most part. So it's going to impact both of these markets. But again, waiting for the rates to drop, you're kind of crossing that line of where rates get cheap enough, but home prices and asset prices are still affordable before they inflate too much.
Yeah, and you're probably wondering, like, wait, I've seen this before. Like, this seems really similar to what we just went through, and depending on how much stimulus the government decides to provide to the Canadian economy, this might be very similar to a COVID level type of stimulus package for small businesses and people. And just to understand like kind of the mechanisms and how this works here, if the Canadian government prints money to help the people, that essentially requires them to drop rates very quickly to be able to stimulate an economy that essentially needs capital to continue to grow. Well, that causes inflation along with tariffs, which are inherently inflationary. If we have retaliatory tariffs, which our government said they would, prices would go up, and then inevitably those rates will have to go back up to combat all the money printing that they did to be able to stimulate the economy. And then we're essentially back to where we were at the end of the cycle right now, which is where we have dropped rates to some sort of normalized level. So I think just all in all, if you are an economist or you don't like following this stuff and nerding out, Aaron and I love this stuff. We keep track of it all the time, but it's never been more important than really ever to understand the economics around how capital essentially is taken out of a market and injected into a market during times of crisis. And it feels as though crisis has become every 2 years or 4 years instead of every 10. So we think it's pivotal that you guys are having this conversation, that we're having this conversation, so you can understand the risks associated with taking on debt, specifically variable debt. Now, for all the homeowners out there and people who have a renewal coming up over the next few years, how is this going to affect you? Well, if we follow the bouncing ball, and we do believe that Trump puts these tariffs on and we have retaliatory tariffs, and the Bank of Canada decides to cut their rates 6 times this year, well, that's going to pull our policy rate decision down, which is the Bank of Canada rate. What that does is it has a direct reflection to prime rate. Your prime rate, if that were the case, would go down another 125 basis points. What that means for any variable rate mortgage holder is direct impact to your borrowing costs. It goes down instantaneously as soon as prime rate drops. So for this kind of renewal cliff that has been coming up that everybody's been talking about for the last few years, this honestly might be one thing that might save us at least from that impending doom instead of the impending doom that we're about to deal with President Trump. So for mortgage holders, if you do have to renew, or you're thinking of renewing, probably wait 30 days. See if these tariffs come into effect, see if we are going to have any sort of relief from the Bank of Canada, and what kind of rhetoric Tiff is actually giving in his speeches. I would assume that there's going to be more talks of stimulus as we progress through having tariffs. Now, whether or not Trump was serious about it or it was just a ploy to be able to have militarized border, who really knows? But all in all, I think that it's safe to say that the government has expressed that they do anticipate some level of stimulus package, which inevitably should cause lower rates.
Yeah, and then immediately after that, start looking into when the rates could go back up, because we know that rates just can't stay low forever. I mean, we've already seen that. So, like Josh said, this is a time where you have to start doing the research and start understanding how the economy is going to shift in focus, because as much as we are expecting, interim rate drops over time, with tariffs on both sides, from the U.S. and the retaliatory tariffs from Canada, and then also the potential loss of business from tariffs for stuff being imported to the States. That is going to create, economic stress in Canada, and down the road, especially with inflation, we could potentially see, or probably will see, rates go back up again as well too. So as much as there is the little bit of the waiting game and trying to time the renewals and timing any purchases, you also want to keep in mind that those rates don't last forever. And there is going to be a period where you can wait too long and then you're going to get caught on the upcycle with rates as well too. And then that again is going to, impact your affordability on anything variable, but also just going to impact interest rates across the board. Again, whether you're buying home, like residential homes, or whether you're getting into commercial assets as well too, all of these cost of funds and all these interest rates are all tied together. So again, there is going to be a little bit of a roller coaster here, trying to catch it and time it perfectly. Obviously, impossible to try to time it perfectly, but you can have your best educated guesses. I think there's going to be a lot of opportunity for investors to be able to get in, as these tariffs come into effect. Obviously, construction costs are going to increase. Potentially going to see a lot of projects, maybe guys pulling out midway or partially way through, where they just can't afford to keep the projects going. Further down the road, when interest rates just start to increase, or if they do increase, you might see sellers enter the market, just relieving some of their assets because maybe it doesn't make sense for them to renew it, or they've held on to it long enough. They have the equity there. So there could be some distress selling down the road as well, which again is going to create opportunity for investors to get into the market.
Yeah, when I'm looking at like what's happening with the Canadian market, I'm looking at 5 years from now, 10 years from now, and I think the pendulum shifts if this happens. If we have an economy, whether it's a depression or a recession, and it's a prolonged period of time, I don't think affordability is going to get any better. For a short period of time, maybe, as Aaron discussed, that window, but if costs go up and we have massive unemployment, affordability doesn't get any better in Canada. And we're moving towards that European-style renters market. So for what Aaron and I have been echoing for the last few years around purpose-built multifamily real estate, I think that the guys who are situated, who understand mid-sized development, who have access to dry powder right now, who understand the debt structure, and who can capture low carrying costs on construction debt and low CMB costs overall, I think the next few years, if it does come down to our economy going into recession, I think that those purpose-built multifamily mid-sized investors and developers who have capital, it's almost like a Goldilocks zone of being able to purchase a distressed property or land that is being written down at 50 cents on the dollar right now. Nobody can move a piece of land. So if you're ready for this and you understand how to do this, I do think there's a lot of opportunity coming up for the Canadian developer.
Yeah, guys, like always, I think one of the key kind of pieces that we keep touching on in a lot of our videos is just educating yourselves and understanding trends and cycles in the markets, real estate markets and the interest rate markets, but also, understanding what this is going to do to those markets as well too from the tariff perspective. So again, take some time to understand some of the economic impacts, what's potentially going to happen, what that's going to look like, maybe what those cycles are going to kind of look like, just so that you can, sit down, get your finances in order, be ready to pull the trigger at the opportune moment, and just make sure you have your goals in line. Because again, we know that when stuff like this happens, it tends to be violent in terms of the timelines, just being that it's hard to predict. So the rates could drop pretty quickly again through the year, but at the same time they could also raise pretty quickly. I mean, we've seen just how fragile the Bank of Canada's decisions with monetary policy can be, and they don't really give you a whole lot of heads up. 1 minute they're telling you to invest because rates have never been so low, and then the next minute they're raising it 400%. So again, just making sure you're ready to go and you have your goals set to be able to pull the trigger.
Yeah, guys, if you guys like this video and got some value from it today, we really appreciate it if you hit the like button, hit the subscribe button. It allows Aaron and I to do more of this to make sure we can keep you guys up to date all the time. Until next time, ciao.